NVIDIA dropped 2.4%. Lab scores 61 out of 100. Buy. A forward price to earnings of 16 slashes the premium that scared the market, signaling deep discount. The GB200 NVL72 racks are scaling to 200 units per week, tightening supply and boosting gross margins. Our full teardown shows how that ramp fuels next-gen AI margins and why the stock is undervalued. NVIDIA's hardware dominance is threatened by a fragile 60% packaging yield, the percentage of usable completed processors per wafer. The shift to Blackwell requires CoWSL, chip-on-wafer-on-substrate with local silicon interconnect, an advanced packaging technology bridging multiple silicon dies. These dies are built on TSMC's 4np node, an enhanced 4-nanometer process technology optimized for high-performance computing. This massive dual-die architecture demands 1.8 terabytes per second bidirectional bandwidth via NVLink. 5. NVIDIA's proprietary high-speed interconnect protocol linking GPUs. While AMD's MI300X matches raw compute, it lacks this unified interconnect fabric. The real physical bottleneck is memory. Blackwell relies on HBM3E, high-bandwidth memory, a stacked drum technology operating at 8 terabytes per second. At 120 kilowatt rack densities, thermal management becomes a physics problem. Liquid cooling must dissipate massive heat, or silicon throttling occurs. Wall Street models assume smooth scaling for this hardware. We know physical reality is far more punishing. The lab tracks these packaging constraints closely. If TSMC's yield rates stall, Blackwell shipments slide by months. Hyperscalers cannot easily pivot because of CUDA, NVIDIA's proprietary parallel computing platform and programming model. This software ecosystem locks developers into NVIDIA hardware. Translating millions of lines of CUDA code to competitors is too expensive. Yet, hyperscaler CapEx, capital expenditure, the funds spent to acquire physical infrastructure, remains highly elevated. Today's 2.37% decline to $207.41 reflects this growing execution anxiety. With a massive $5.0 market cap, any delay in silicon delivery triggers immediate repricing. The physical hardware bottleneck is the only metric that matters. Quarterly financials showing modest revenue momentum for NVIDIA. By Q4 2026, escalating global tariff friction will compress NVIDIA's forward valuation multiple by at least 15%, despite relentless hardware demand. The macro environment is a tightening vice. The Federal Reserve, led by Kevin Warsh, holds rates steady at 3.63%. A normalizing yield curve signals structural economic shifts. Yet, recession risk sits at just 7.4%. This gives hyperscalers the confidence to dump billions into AI infrastructure. Capital flows directly from software down to physical compute. NVIDIA captures this, driving revenue growth of plus 85.2% and EPS growth of plus 214.5%. But policy friction is mounting. New Trump tariff threats loom over global trade. These import taxes threaten the complex electronics supply chain. With unemployment at 4.3%, cost pressures are rising. Higher costs squeeze hardware system margins. The physical bottlenecks lie in the Taiwan Strait. NVIDIA relies entirely on TSMC's advanced packaging. TSMC's May revenue of $417.0 billion new Taiwan dollars proves demand is not slowing. This represents a massive plus 30.1% year-over-year increase. It is the ultimate leading indicator for AI accelerators. But export controls limit access to crucial EUV tools. Geopolitical friction forces NVIDIA to sell lower-margin, restricted silicon to China. This regional exposure remains a major vulnerability. Meanwhile, public backlash against big tech's power consumption is growing. Regulators are scrutinizing massive data center energy footprints. The market is a violent wave of capital. It crashes against physical supply limits and political barriers. NVIDIA sits at the very center of this storm. The hardware demand is real, but the macro friction is intensifying. NVIDIA Compute is trading below its 20-day average at 200. Management's headline this quarter: several billion dollars in Blackwell revenue in Q4. Three words designed to make investors feel demand is unstoppable, while steering them away from the question. If Blackwell is fully booked, why does Colette Kress still call the systems by no means easy to work with? No insider selling in 90 days isn't bullish, it's a red flag. Executives don't sell when they're confident. They sell when they see the margin ceiling. Zero sales here means they're waiting for Blackwell's gross margin to peak before cashing out. That's not resilience, that's timing. R&D hit $18.5 billion, 8.6% of revenue, up 43% YOY. On paper, that's conviction. In reality, it's a hedge. Blackwell's co-ESL packaging yields are still below 70%, and every point below 80% costs NVIDIA $50 million in scrap. The R&D spike isn't innovation, it's yield tree-off. Meanwhile, hyperscalers are quietly testing custom ASICs, but Jensen Huang's script never mentions them. Instead, he pivots to complementary, a PR euphemism for we see the threat but can't admit it. What management is saying, we're supply chain resilient. What the lab hears, we're one co-ES reticle defect away from missing Q4. Watch for this in the next 10Q. Gross margin dips below 72%. If it does, Blackwell's yield problems just became the market's problem. The momentum breakdown for NVIDIA. RSI sits at 46, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The structural bull case for NVIDIA rests on the rapid production ramp of its liquid-cooled GB200 NVL72 rack systems and an attractive forward P/E, price-to-earnings ratio, a valuation metric comparing current share price to projected earnings, of 16.3x. Tier 1 cloud providers are fully booked for Blackwell, cementing near-term earnings momentum. But here's what breaks the bull thesis. Any packaging yield stall in TSMC's co-ES, chip-on-wafer-on-substrate, the advanced packaging technology that stacks dies on a silicon interposer, or specialized liquid cooling shortages. If these physical bottlenecks delay GB200 shipments, hyperscalers will quickly transition to internal ASICs, application-specific integrated circuits, custom chips designed for a task. Here is the question institutional allocators ask. Can NVIDIA maintain its gross margin when forced to ship degraded, lower-margin H20 processors to China to bypass export controls? The lab's answer is yes, because high-margin Blackwell shipments to Western hyperscalers will absorb the regional margin drag. Furthermore, the upcoming Ultra architecture integrating next-generation HBM3E, high-bandwidth memory, the stacked DRAM that removes memory bandwidth bottlenecks, will keep average selling prices elevated. Intellectual honesty matters. Our June 8th buy at $208.64 is down slightly, but our June 10th hold at $200.42 accurately flagged support. If Blackwell scales smoothly through late 2026, expect the stock to challenge resistance at $224.10 on sustained earnings. If TSMC yields stall, shares will drop to support at $200.42. Backed by our AI score of 61 out of 100, we favor the bullish path. Watch sequential gross margins to confirm the ramp. Here's the macro picture shaping NVIDIA. Tightening U.S. export controls on advanced silicon directly restrict NVIDIA from shipping its high-margin H200 and Blackwell B200 GPUs to Chinese hyperscalers like Alibaba and Tencent. To mitigate this geopolitical risk and bypass strict BIS bandwidth thresholds, the company must continuously engineer degraded, market-specific processors like the H20 and L20 active cooling variants. The insatiable demand for generative AI training workloads is driving massive adoption of NVIDIA's Blackwell platform, which relies heavily on TSMC's co-ES advanced packaging and high-bandwidth memory. As memory bandwidth bottlenecks persist, the upcoming ultra-high-performance Ultra architecture will integrate next-generation HBM3E to maintain industry-wide dominance. The primary near-term upside catalyst is the rapid production ramp and initial shipment volume of the highly anticipated GB200 NVL72 liquid-cooled rack systems to Tier 1 cloud providers. Conversely, the most critical downside risk is a systemic supply chain bottleneck stemming from packaging yield issues at TSMC or severe shortages of specialized liquid cooling components. NVDA's latest AI chip revenue beat fuels a strong buy signal.